Hey everyone, welcome back to the Vanilla. This is your no-nonsense guide to investing in Canada. Now, there has to be a method to the madness that is investing, and I've simplified it with these 6 key areas. The first one is educating yourself. The second one is understanding the account types in Canada. Third one is creating a simple investment strategy that works for you. Fourth, we'll go into choosing an investment platform. Fifth, make your first investment and how to do that. And lastly, research, and more research. Suppose you're about to hike up a mountain for the first time. Would you start without a map or without knowing what the trail is like? Unless you're full of arrogance and want to wind up with trouble during the course, you'd probably say no. Well, investing is no different. It pays to know the basics before you jump in. You can refer to my previous video to understand a little more about the basic terms you might want to familiarize yourself with as you start investing. So educating yourself. Here are 2 things I would say that would be worthwhile to wrap your head around. Firstly, types of investments, and secondly, risk and reward ratio. Higher potential rewards often come with higher risks. So if you feel at this point in time you want to minimize risk, it might be worthwhile to put most of your money into a savings account. This way, you know you will get a certain return. Whereas, if you feel like you can take on some risk and won't worry too much if you lose some of your money, whilst knowing that there is a probability of making a huge return, you may put it into a high-risk asset like crypto, for example. Again, this is obviously not an advice, it's just an example. Second point that we wanted to talk about was account types in Canada. Now, I like to think of investing accounts like special suitcases, where you store your investments. Each suitcase offers different advantages. We won't go into the details of each one right now, that is a separate conversation altogether, but I will explain at a very high level how TFSA and RRSP work from a tax standpoint. Suppose Lacey has a salary of $60,000 and would like to invest $5,000 in either TFSA or RRSP account. She gets no tax benefits when she deposits it, but she decides to withdraw it 10 years later, and suppose the money in TFSA grows in value. At that point in time, she does not have to pay any tax on the investment from TFSA whatsoever. How about RRSP? Well, if Lacey deposits $5,000 into her RRSP, the year she does, that amount would be deducted from her taxable income. So since her salary is $60,000 and she's deposited $5,000 in her RRSP account, she will get a tax exemption for this $5,000. This means that she will only have to pay taxes on the $55,000. Now, fast forward to 10 years later though, suppose she decides to withdraw it and the money in RRSP grows in value by $20,000. At that point in time, she does have to pay taxes on the amount she will be withdrawing. Obviously, this is an oversimplification, but hope this gives you a better understanding of how each of these work. Third topic that we want to talk about is your investment strategy. Now, here are 5 basic questions that you need to ask yourself to define your strategy. Firstly, what are you saving for? Secondly, how much can you afford to invest? Third, how much risk can you handle? Fourth, how long can you leave your money invested? And last, what are the tax implications of your investment choices? Let's talk about investment strategy for Lacey. Firstly, what are you saving for? Lacey is saving for short-term goals. She has a vacation coming up in 2 years and has a long-term goal as well, which is retirement in 30 years. So because of this, she needs to balance both needs in her strategy, short-term as well as long-term. How much can you afford to invest? Well, Lacey follows the 50-30-20 rule. 50% for her needs, 30% for her wants, and 20% for her investments. Supposing a total compensation of $60,000 a year and she does not have any debt, suppose she wants to invest 20%, which means $12,000 per year. Now, she also sets aside $7,000 as emergency funds into a savings account, which she can pull out at any time, and it's growing in value by roughly 2 to 3% per year. Now, she has $5,000 available for investment per year. The third question that we ask is, how much risk can you handle? Lacey knows she's a cautious investor. She can't handle seeing big decreases in her investment, even if there is a chance of investment bouncing up in the future. So she prefers moderate risk to avoid big fluctuations. Hence, she's considering ETFs that are diversified across sectors at this point in time. The fourth question that we ask her is, how long can you leave your money invested? Well, vacation is a short-term goal, so need to choose a more stable investment for this portion, and retirement is a long-term goal, so she can keep that money in there for longer term. And she can decide to choose more growth-focused investments for this portion because she has more time in the market for that value to grow. The last question that we talk about is the tax implications. So RRSP will be more beneficial for her retirement savings because once she retires, even if she takes the money out, she might not be earning, whereas TFSA may be a good choice for her vacation savings. So what's her investment strategy? Firstly, emergency funds. So she's going to put that into savings account, grow that at a fixed rate of around 2%, 3% a year. She doesn't mind, she can pull that money out whenever she wants. Then the short-term goal. She has a vacation coming up in 2 years and she wants to use TFSA to invest $1,500 in a mix of conservative low-risk assets so that she doesn't lose that money in the short term. And in the long term, she wants to invest in a diversified ETF with higher growth potential. Now let's talk about investment platforms. If you're new to investing in Canada, my personal suggestion is that Wealthsimple might be a great intuitive platform to start off with, and has no commission charges. So Lacey in this case says, I'm just going to be investing in Canadian ETFs. I think I'll start off with Wealthsimple. Whereas Mark over here thinks, that's a great idea, but I'm more of a US stocks investor, and I've heard about Questrade, and that might be a better option for me, and hence would have to pay less tax. And we can get into the details of Wealthsimple versus Questrade and other brokerage firms later on, but at a high level, I would start off with Wealthsimple. Now let's move on to our fifth pillar, choosing your first stock or ETF. There are 3 steps that you need to be mindful of. First, learn and shortlist based on your strategy, the strategy that we defined earlier. Then analyze insights based on the ETFs that you choose, such as historical performance. And then start small and buy your first stocks or ETFs. The first step along the way is learning and shortlisting based on your strategy. For Lacey, who's a cautious investor, she believes these 6 fit into her strategy. VFV, because it provides a broad exposure to the US stock market. XIC, because it provides good exposure to the Canadian stock market. VBAL, because it has a good balanced portfolio with 60% stocks and 40% bonds mix, which is baked in diversification. QQQ focuses on large cap growth stocks. She believes that, especially because of its exposure to the tech sector, it would be a worthwhile one to look at. VCN, because it offers broad exposure to the Canadian stock market again. And VWO provides exposure to emerging markets just to diversify the geographical landscape as well. How we can analyze insights for one particular stock. In this case, let's talk about VFV. So you can start searching on Google, you can search for composition of the VFV ETF, and you can click the first link that you can see. Now, when you get to the page, you'll be able to see multiple details, fund objectives, why this fund exists, some fun facts as well. And you'll also be able to see important information such as what exactly is the growth of this fund in the last year, 3 years, 5 years, or since its inception as well. As you move down, you'll be able to see some important profile data for the stock or the ETF in this case. And you'll be able to see important ratios, price to earnings, price to book, return on equity, earnings growth rate. We'll go into details about what these mean, but you'll be able to see the definitions as well when you click along. You'll also be able to see the market cap, and you'll also be able to see the weighted exposure. Which sectors is it most aligned to? In this case, you can see that 31.7% of the fund is aligned to the information technology sector, whereas financials, healthcare, consumer follow. You'll also then be able to see, and this is an important one, to see the holding details that the fund has allocated to. So you can see that Apple is 7.11% of market value of the fund, whereas Tesla is 1.43512%, and there are 504 total holdings. Now Lacey is ready to buy her first ETFs. She's starting small with $1,000 and has decided that she will be investing in VFV, VCN, and VBAL. VFV because it has a good exposure to the US market and it tracks the S&P 500. She's given a slightly higher allocation here since VFV exposure to the US market has a greater opportunity for higher returns. Moving on to VBAL, this ETF aligns well with her cautious nature and preference for moderate risk. It offers a balanced mix of 60% stocks and 40% bonds, providing a good compromise between growth potential and stability. And lastly, VCN because it tracks the entire Canadian stock market, which is Lacey's local stock market, offering broad diversification within Canada. The last pillar is research, and more research. Say that, hey, as an ETF investor in VFV, provide a brief analysis of current market trends in the United States. Focus on key growth areas, risks, and emerging opportunities based on recent developments and market conditions. Offer a clear recommendation for future investment strategies. Keep the insights concise and accessible for both experts and beginners. Now, what it'll do is it will actually search through the internet and identify based on articles, news, any kind of information that's available and synthesize this for you. So it says that, hey, as an investor in VFV, it's important for you to understand the current market trends and outlook for US equities. Here's a brief analysis of the key factors to consider. It gives you a good market overview. It's also highlighted the key growth areas in technology, communication services, and financials that you can look at. Now, there are some risks as well, which you can deep dive into in terms of valuation concerns, economic slowdown, interest rate uncertainty, as well as emerging opportunities. Now, you can go and have a deeper dive into any single one of these that you feel is worthwhile looking at. In case you feel that there is an emerging opportunity in the energy sector, you can look and search further about it or ask questions related to it to enhance your knowledge. It also gives you investment recommendations such as maintaining core exposure. Keep VFV as a core holding for the broad US market exposure, but consider complementing it with targeted allocations. It also provides all these other suggestions and recommendations which you can look further into and enhance your research. Well, alright, thanks for watching, and if you're looking forward to more content, please give a thumbs up and hit that subscribe button. But until then, as always, keep it simple, keep it vanilla.